with interest rates going up now, there's a good chance you're going to hit 17% affordability this year. That makes other charts turn negative. It makes, historically, 2 years after 17% affordability is hit, you have unemployment go up a lot.
Hi, this is Chris German. Welcome back to the Apartment Dealer Show. Today we have a special treat lined up for you. I will be interviewing Mr. Bruce Norris. Now, for those of us that are real estate investors here in Southern California, the name Bruce Norris is a household name. Bruce has most widely become known because of his ability to predict the trend of real estate markets, whether they were headed up or headed down. And as a real estate investor himself, educator, and hard money lender, he's amassed a fortune through following the charts, as he refers to them, and has helped many, many investors like you, landlords like you, along the way in terms of his projections, his thoughts, his opinions of what he sees in the market. Obviously, with all that is occurring today when it comes to inflation, the politics of being a landlord and owning rental real estate, new tax laws that are proposed in terms of punishing those would-be flipper type investors, and all the rest, we're going to dive into, well, what can we make, what sense can we make of that? What can history tell us about when there's been inflation or rising interest rates in the past? Can that tell us anything about what's to come in the future, right? Does history necessarily repeat itself? And what should we be on the lookout? What should we be cognizant of as we're deliberating on our next real estate investments? So with that, help me welcome Mr. Bruce Norris. So Mr. Norris, welcome to the show.
Chris, thanks for having me back.
Now, we used to see each other more often before you went to live across the country. At least we'd have a sit-down interview here and there. But of course, we're preparing for our apartment owners educational luncheon. I know that by adding you to the event, the landlords have found that very informative, very helpful, because of course, in some ways, how residential real estate goes, so goes multifamily, because at times you can be competing for tenants and what have you.
Sure.
And so I thank you for your time here today. First question I have for you is, how much is a gallon of gas in Florida right now?
It's about $4.20.
Wow. And here we are, $6, hovering around $6, depending on where you are in California.
Yeah, that's been about the ratio, 2/3 Florida price to California, you know.
And I raise that question because, of course, inflation is not only on real estate investors' mind, it's on consumers' minds. And the Fed had a target rate, I think, of 2%. Obviously, we're growing at a much faster rate than that. We're at a 40-year high. What historically does inflation typically mean to real estate?
It's a great question, because the assumption will be that if you have inflation and you try to stop inflation, you'll raise interest rates, and that damages real estate prices. And all that sounds like that has to be true. That's why I love charts. So from 1974 to 1980, interest rates doubled from 7.5 to 15. Prices in California, single family real estate went from 34,000 to 102.
So let me stop you there, because like you just said, that seems contrary to what common knowledge would have. So how is it that home values went up by that much, and yet essentially the consumer was losing buying power, right? Because as the interest rates rise, you're losing buying power is the way I would describe it. How did that come about?
Well, it's a really an interesting combination of things, and I've studied it a lot, so I'm definitely prepared for the question. When you have, first thing you have in inflation is you have inflation of what you make. So Cal Poly Pomona put together a study that was very brilliant because it was kind of in advance. 1970 to 1980, they had a builder price out the same exact house every year. So you could see a progression of what it costs per square foot and what it costs per dollars for the same house for the decade of inflation. Then they also did all that for the wages, every wage that was involved in a house. So what did the electrician make in 70? What did he make in 80? How much did lumber cost as part of the bid? It was really an amazing thing. I was lucky to find it because it was hidden in a vault. Literally one copy per quarter, they would produce this. And so I was very fortunate, but when I found it, I was, oh my gosh, this is like the holy grail of progression of inflation.
Right.
So what occurred was you were gaining in buying power if you were just looking at your wages. So you went from $7 to $15. But then if you looked at where prices went, the truth is you lost buying power, but in 74, affordability wasn't 17, it was 45. Now 45 is very high affordability.
Mm-hmm.
So what happened gradually from 74 to 80 is as interest rates went up to take away your buying power, your earnings kind of fought against that and maintained buying power for quite a while until 1980. In 1980, you hit 17% affordability, but at a crazy interest rate.
Mm-hmm.
And so what's important to realize is as long as I have been in the business, from 1980, I got in the business 1981 to right now, interest rates have basically gone down the entire time with very little bits of it going up. So now going forward, it's really going to be interesting because if affordability is an important piece, which I believe it is, with interest rates going up now, there's a good chance you're going to hit 17% affordability this year.
Mm.
That makes other charts turn negative. It makes historically 2 years after 17% affordability is hit, you have unemployment go up a lot. You have inventory for sale go up a lot. Usually building declines a lot. But this cycle is a little different, okay? So, basically the presentation will really take a look at what happened in 1980 and 2 years after that, 89 and 2 years after that, 2006 and 2 years after that, and figure out why one of them had devastation in price, one of them had no change in negative price, and one was mild price. What was the difference? Because that's what we'll talk about when we have the meeting, because it's really important to realize that the key ingredient to damage isn't interest rates. It's something else.
I thought that you would mention wages, and it's the darndest thing. My first job as a high school student was McDonald's, like many people. And you were just happy to have a job. They want you on the fries. They want you in the, hey, you're going to be wherever you need to be. Well, now, you got people demanding $20 an hour at McDonald's, 20 some dollars an hour at Target. So, and again, I don't know, I'm not an economist. I don't know if that's only happening on the lower end jobs. I mean, it's not happening. Is it happening across the entire spectrum when it comes to wages? But obviously, if it rolls over and it begins to spill over into the wages at large, then that helps with the affordability index.
Well, it definitely helps it. You're going to have that, but when you're qualifying for a loan, do you get your full increase to qualify with? No, it's a ratio.
Mm-hmm.
So it always lags interest rate hikes. So you will have less buying power. So to give you the exact number, if you could buy, I'm trying to make sure I remember this right. There was a 17% decline in the actual buying power during the years the wages doubled. So you lost 17% of net buying power despite the fact that your wages doubled. See, the other thing, Chris, that's really interesting, you guys own apartment buildings. That's a commodity. Mm-hmm. It's not just it doesn't just produce rent. There's going to be a correlation between the cost of building a new apartment building and an existing apartment building. So it's all commodities. Your building is made of lumber. It was made with labor and land cost. Well, there's a correlation between the cost of a new one and the value of an existing one. In the housing world, they actually invert at peak markets. So for only the third time that I know in history, an existing home is more costly than per square foot than a new one. So when Lennar's walls cost them more to build because lumber went up, the lumber in your rental went up too. It's one of the reasons why we own real estate. It's an inflation hedge fund that cash flows.
Well, this is one of the competitors right now, especially when it comes to your hard money business. I'm sure you're hearing investors complain that the cost of rehab has gone up enormously in terms of the material, labor costs. I mean, labor. Guys that would have asked, say, $200 a day before are asking $300 an hour. And that happened in a 6-month period. It's not like we had a big run up to essentially those wages going up by a third. 2x4s used to be, I think, like $2.40. Now they're over $8. And so at least as we're looking at projects, the margins are getting thin. On your side of things in hard money, how do you account for that? That you know that that's competing with individuals that are looking to come borrow money from your firm. How do you guys look at that?
Well, we're really in the business of not only speccing homes in Florida, but we have our investors building homes to end up with rentals. And we just had a meeting, where we maxed out on how many people wanted to go to Florida to discuss transferring some of their assets, doing 1031 exchanges. And part of the conversation was that we're going to build a house that's going to take, let's say, start to finish 9 months when you talk about permit and construction time. During that time, you probably will have a price increase that is not going to be guaranteed by the builder because he can't. What we're doing is we're trying to build something with an equity position. So you have to accept the fact that your costs are going to change, or there's no point in the builder doing it at all. So he wants a net profit. And if the costs are more, we have a very proactive builder who tries to solve any of these things that he can, but some of them you can't. So the reason I mentioned that, here's the other advantage, is that while you're constructing it, if inflation is taking your costs up, it's probably being doubled by your price increase. And that is in fact true. Now, I don't know if that's true in apartments, but I can tell you that it's true in rehabs and it's true in new construction. There's so many stories of the properties, you think you're starting to build something, you think it's going to go for 4.25 when you start it, and then you list it at 5.25, 25% bonus, and then there's a bidding war that takes it to 575. I mean, that just happened last week.
Well, and that would be a sweet end to the story if that's how things go. But, at least in the multifamily market, we just recorded a video on interest rates and what impact that has. Not so much on values, but in the sense of, well, what does it mean to your net income, right? Because in the apartment world, we have cap rates, which essentially tells us our rate of return. Well, that's getting compressed. Okay, that spread between interest rates and cap rates. So what does that mean to the average individual? Well, if interest rates go above cap rate, that means you're losing money on the money borrowed effectively.
Yeah.
And so what will that mean to the market? And will rental rates grow fast enough, high enough to compensate, to absorb? And I think that's the biggest question right now for landlords, is what's going to take place with tenants' wages? Because right now they're getting murdered at the grocery store. They're getting murdered when they go to fill up at the pump. If they don't have an increase in wages, I don't see how rental rates would continue to increase and somehow absorb these 7 interest rate hikes that the Fed has promised that we're going to see over the course of this year. What are obviously you're in the lending business and as an investor, but what's your take on the fact that the Fed said, hey, you know what? We are going to raise the rate 7 times. Just here recently, they said, hey, maybe the next one is going to be not just a 1/4 point, it'll be a 1/2 point. I mean, they're hot and heavy raising rates.
Yeah.
What do you think that means to us as investors?
Well, I just did a presentation to a real estate company, and we talked about that. And somebody mentioned that he just he refinanced something that he owned. Instead of getting a fixed rate loan, he got an adjustable, and the starting rate for 10 years was fixed at 2.5. So I think you're going to start to see a lot of adjustable mortgages with, pretty long-term fixed timeframes. And that can make up the difference, let's say, in the affordability. When you're talking about cap rates, though, let's say what's a cap rate now on an apartment building? 4 or less?
Right? Yeah, good.
Yeah.
Yeah.
Well, if you get a 10-year T-bill pay you 4%, that's a competitor,
Right.
and that doesn't have a tenant. So I think that's where the apartment world and the housing world separate, in that you're really more sensitive to what are the cap rates are available without risk and without hassle. Plus your valuations. I mean, how has an apartment valuation changed during this time? I mean, it's gone up because of the compression of cap rates.
Right.
Okay, so what happens is there is a decompression where the person that says, well, I'm not going to own that until it's a 6.
Right.
I mean, when you got into the business, what was it? That's not unheard of, right?
No, not at all. And when I got in the business in 2007, interest rates that we would quote or underwrite buildings with was about 6.5%. And historically, that wasn't all that bad. I mean, that sounds atrocious today, we're at 3.75 for an average apartment loan. But
Yeah.
6.5, and the market was trucking along until, of course, we had, the calamity of 2008. But yeah, I mean, it's going to it creates pressure. No doubt. It definitely the rising interest rates creates pressure. And that's why I bring it back to the wages. Now, maybe in a different direction, because of course, at our educational event, politics in the sense of what laws are coming to pass are being dreamt up that will affect investors. Now, here, just recently, they're talking about a special tax if you flip property. So I'm sure your clientele is most concerned with this. Can you give us just a 50,000 foot view of what's entailed in that proposed law?
I wish Aaron was here to tell you, but I can tell you what I know about it is that if you have bought a property and you are flipping it, they intend to not just for you pay state income tax, that you pay a 25% tax on your profit. And because you are somehow damaging the real estate market because you are taking inventory away from an owner occupant. And that since you're a greedy investor, they're going to punish you with 25% tax. So then if that's a flip, it's fully taxable. So you have, let's say, a maximum Fed rate plus your maximum state rate plus your 25% tax because you exist. Well, you just might pass on that activity. And then would the real estate world really be better off without flippers? And that's kind of what this is telling you, is that they think that would be true, except for they don't understand what we do. And so that's the thing about an investor who is adding square footage. And so here you are, you're in this trend of we need extra housing. Well, you've made it impossible for a builder to get an approval on a tract. I just got an email from a gentleman. This is really true. He sent me an email saying, I'm so happy. I just got approval on my tract of land after 19 years.
Where is he located?
He's located in Orange County, but that was a tract in Menifee.
Oh,
he's been trying to get approval. In an interview with the president of the Builders Association a few years ago, I asked, what's the difference between how you would look at a building project in Texas versus California? And his comment was, in Texas, you ask, how's the economy going to be like next year? And in California, you ask how's the economy going to be in 15 years? And for this guy, it was 19 years.
Wow.
So you're creating the same type of thing. The builder who creates the tracks, they're hurting the environment. So let's don't let them get there to the finish line. And now the investor who's taking a junky house and making it great is going to get penalized too. Well, the builders have left. And you can tell that by a building chart. Normally at a peak market, so let's say this is a peak market that would be similar to 89 and 2006. 150, 160,000 new homes are built in peak markets. We didn't build 60,000, and we didn't build 60,000 any year in the last decade. So the reason you've got a housing shortage is you're missing about 700,000 homes that would have been built that they can't get approval on. So now you're going to do the ADUs in there on everything. You know, that's where California's headed.
With respect to Californians moving throughout the country, right, vacating and moving to Texas, moving to red states is what you most commonly hear, and ruining the politics, or wherever they decide to plant themselves. But do you see? And of course, you're heavily invested in Florida.
Yes.
You reside in Florida. Any fallout of that yet, of the California transplants, or any type of rumblings of laws that now makes Florida less advantageous?
It's interesting you mentioned that, because actually Florida is more conservative now than it was, say, 3 years ago. But it doesn't get migration from California, but it does get migration from New York and New Jersey, a dominant number. So they are usually Democrat states, but I just saw one of those studies that said it's more likely to be more Republican than Democrat now. So, sometimes when you go through painful lessons, you say, you rethink things. And that's maybe some of that's going on where, yeah, this isn't working too good.
Now, at our 2019 event, I always like to point to this, because how interesting it is that from stage, you asked the simple question a couple, 2-3 times: what if we were to experience a systemic event? And of course, you didn't know that a health crisis was around the corner. Maybe Dr. Fauci did, but definitely Bruce Norris didn't know, right?
Right.
And I'm curious, the charts, I know you're the charts guy and you rely on the charts, not your opinion, but that's why you're credible, because you don't allow your opinion to get intermixed there. I mean, you have an opinion of what the charts, but right, you're heavily relying on the data. What was the trend as we were exiting 2019? And now, 2 years later after COVID, has that trend returned? Are we completely on a different spectrum? Where are we? Versus.
Yeah. Well, it's a great question, because at the end of 2019, one thing Cal Poly also does, it did that report where it looked at all the wages over a decade. They also appraise about 1,000 homes every 6 months, the same home for the last 40 years. And they basically say, what's the price change in the last 6 months? Well, by the time 2019 was ending, the report showed that almost 25% of the inventory that they look at was losing value. That was a number that was really, holy cow. That's similar to, let's say, a number that would have been around in 1990 or 1989, that type of thing. So it really started to say, even with wonderful charts, we're coming to an end of a cycle, which didn't make any sense. You have no foreclosures, you had great employment, but we were not going up in price anymore. We were really stagnant. And then the coronavirus hit. And what that did, it created 2 boxes of urgency. I didn't think about it going forward until there was that systemic event. But what happened was, Chris, first thing, if you had your home listed, you unlisted it. So 50% of the listings disappeared within 30 days. But another group of urgency was created saying, I have to get out of the unsafe living quarters that I'm in, or I have to go buy something instead of be a renter, or I get to migrate from San Jose and go to San Diego and work, and it's half of the price.
You need more space, work it from home, that whole dynamic.
Yeah. So all of a sudden, that stuff started becoming a bidding war, as you know, and it's still going on. So if you have a house for sale in Corona, for instance, I just spoke to the office I'm really familiar with. It's not uncommon for overbids to be $50,000 or $100,000 on an 800 grand house, and it happens every time because they have like 19 days of inventory. So it's done something I couldn't have imagined, but now you're getting to a math equation to where if they're actually qualifying, if they're being requested to really qualify, there'll be a monthly payment barrier that's reached toward the end of the year for housing. Now you can adjust that by saying, okay, they're going to get wage increases and they're going to go to adjustable loans. Okay, I'll buy that for somewhat, but you're sort of going to have two worlds of interest rates. You're going to have the base of interest that are in place at 2.5% or so, and you're going to have a new mortgage that could be very different. So that'll be an interesting world. You'll have people that'll go, well, I'm not leaving in. I see. So inventory that would be available, somebody's going to say, no, I'm good. 2.5, I'm staying. Mm-hmm. So it'll definitely curtail volume of listings. So it'll be very interesting. I do not see price damage coming other than the math equation of if you're at 17% affordability at 4 interest rate and then interest rates go to 6, well, it isn't going to work at that price. It doesn't mean you're going to have a catastrophe. It just means that the buyer will not get a yes answer at that number. Right. So you either have a lot less sales, which will eventually raise inventory, or you have equal number of sales and it'll just be at a different price or an adjustable loan, but something will have to give.
And so, the multifamily world was on the same trajectory in 2019. While values hadn't necessarily shifted, you definitely could sense a slowing of the market. And whether I was interviewing escrow offices just to see how the volume was, if I was talking to 1031 exchange companies to see how much was in the pipeline, everybody was reporting the same thing, that there was this slowdown. And then all of a sudden you have this global event and it gave the market a lift that it was so dire in need of. It gave it the lift. And again, with the stimulus and what have you. But it seems to me like I was speaking with our team, and I didn't even know this was a concept until somebody told me. But it's like, the market needed was going to go through a shift, and obviously all markets go through cycles. But because we want to prolong the good old days, you have more and more stimulus and the Fed moving in and buying bonds and buying debt, and just to keep the market rolling. So you're stretching this rubber band and you continue to stretch it. Well, the more you stretch it, it's going to hurt more when it snaps back. And they should have just let it go here, but we've decided to pull it way back. What will it mean? What will it mean on your side of the world when you reach that affordability index? And if we haven't had an increase in wages, what will it mean on my side of the table as interest rates rise? And if we can't get rental rates to push up, what will that mean?
Well, I think it's just a math function. So, I mean, we chart all this stuff and we say, okay, we do it every quarter. We take a look at the median price and also the median price in every county and say, okay, here's the median price. And our expectation, judging from current earnings, it has a maximum price of this. Well, there's some counties that are already there. So San Francisco, San Jose County are already beyond where they should be. So it's either not going to be maintained, especially if you have an interest rate hike. So that's, we're coming to a point where residential real estate usually stalls. It doesn't mean it goes down, but it means it has charts that turn negative. Volume of sales go down, volume of inventory goes up, unemployment goes up. All those things in the next 2 years, I fully expect. Now, part of what we're going to talk about at your meeting is why did it create 3 different endings? So 17% affordability turned negative charts everywhere, every time, but the price damage was devastating one time, it was positive one time, and it was in the middle one time. And that's the fun of looking at charts and trying to figure out why the difference. So that's really what you have to look at is, are we going to create the scenario where we had the biggest price decline, or are we going to create the scenario where we have no price decline?
Well, I'm sold. I'll sign up and take a seat right now just to get that answer. But yeah, I mean, Between you and the other speakers involved, I mean, especially this time around, there's a lot of ground to cover. A lot has happened even since we were together in October, and a lot of information to assist the landlords. Before we wrap up, I thought I'd ask you this question. I thought this would be very interesting. Let's say that you were starting out in real estate investing today. All your money, your wealth you've accumulated, gone. The properties you currently hold, gone. The only thing you get to use is the knowledge that you've accumulated in all these years of investing. That's the only thing you can use. And you have to start today, somewhere, somehow, investing in real estate. What do you think you do at that point?
I'm going to just share with you a story that's actually true. So that challenge was suggested probably in the early or mid 90s by a guy that I wrote for a magazine. He said, basically, you don't have any income. You don't have any assets. Let's see what happens in 30 days. And so basically I had to use what I knew. And as I recall, in 60 days, I owned 13 houses and a condo to live in free and clear. So I guess there's always a way. Now, one of the things I would do, I always get asked this at market peak. So should I sell my residence? And I thought about that one time when I, wrote that California crash report. My house in Riverside was worth about $1.2 million. I even called a guy that had a rental property and said, I'm not your normal renter. I'll pay you in advance. And he was all excited. He said, let me ask you a question. Do you have any pets? And when he asked that question, there was a bell that went off and went, I don't ever want anybody to get to ask that question to me again. I sold it for $700,000. I lost $500,000 staying there. And would I do it again? In a heartbeat. So residences are different to me than investments. Investments, that's a different league, but having my name on a residence, so that, when I talk to real estate agents, they're thinking, am I doing somebody a disservice by getting them in at a market peak? Well, I'd have to say no, because I would be one of the buyers, because I want to call the shots inside that little box. Interest rates aren't terrible because I have a longer chart than most people look at. They're thinking it went from 2.5 to 4, and I'm thinking it went down from 17.5.
Right.
Because I refinanced my house to be an investor at 17.5. So, it's, I would find a way to buy profitable deals because I understand that they still exist. I fund millions of them every month, and I've been around it, so I understand that it still exists.
Well, Bruce, we thank you for your time. We know that there's many other things you could busy yourself with, but we appreciate you coming on the Apartment Dealer Show, and we look forward to having you at our Apartment Owners Educational Luncheon. Till then, be well.
Okay, Chris, you too. Thanks.
All right, thank you.
All right.
Well, there you have it, folks. I refer to him as the Sultan of SoCal real estate. I hope you found the information that Bruce shared informative. Of course, Bruce alluded to what's going to be covered at our next Apartment Owners Educational Luncheon. For those of you that own multifamily real estate in Los Angeles County, San Bernardino County, Riverside County, Orange County, this is a venue where we host only a handful of investors, if you will, right? It's not 1,000 landlords, but we keep it more intimate. But where not only Bruce Norris, but Gil Figueroa, Stephen Spear, Mike Brennan, those individuals that you've seen me interview over the course of time on this show, we come together to address your questions. What's on your mind as a landlord? What's on your mind as a multifamily investor? What challenges are you currently tackling? And what or how can we assist you in the building of your financial legacy in multifamily properties? That will take place shortly. We have interviews with the other speakers involved coming up here in the coming weeks. So I highly suggest, if you have not done so already, I don't know why you wouldn't have, but subscribe to our channel so you get the alerts when we release these interviews. Much is to be said about the trends and trending topics when it comes to investment real estate that we'll be covering. And give this video a like, share it with other investors that you know. It will help them greatly. This is all free information that helps you with the in and outs, the day-to-day management of your investment portfolio. And until next time, Chris German wishing you positive cash flow, tenants who behave, and much protection from Uncle Sam. See you then.